Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with Mr. Dan Bird. How you doing, sir?
I'm doing pretty well. I survived. I survived
Yes.
Ian. I should have a t-shirt.
Yeah, I
I
survived
survived
Ian.
Ian.
Yeah, well, actually, we probably should have one for I Survived the Market as well, because again, video number one was great. The audience wanted to check on you. Thank you for all of that. But
By the way, quite a few of your listeners sent me notes after they got my newsletter, which I sent out yesterday, that
nice.
kind of described and had pictures and described it. We just went through some of that. But I got some notes. You know, you have very, very nice listeners.
I love that. Good people. I attract good people. That's awesome. Well, we've missed you. It's really been 2 weeks, and it feels like the hurricane has hit the stock market. I believe we took out the Bowley bottom.
Yep, Bowley bottom is gone. It's that happened Friday, actually.
Yeah, so at
least the close below it was Friday.
Yeah, and we now see more and more earnings, right? Nike earnings, horrible. Micron earnings. Earnings were okay, but forecast was horrible. Could we finally have the earnings recession coming? Could 3,200, will 3,500 hold? Are we going to 32? Lots of crazy stuff. The audience is just wants to hear what you are thinking.
Yeah, I'll show some graphs on all of that kind of stuff. But Apple too. I mean, Apple got some downgrades as well.
Apple got downgraded by Bank of America. That never happened.
Right.
Yeah.
So I mean, Apple's a main one for the technology side.
Yeah, I think we talked about it 2 weeks ago, right? There were two stalwarts left, Apple and Tesla. It looks like Apple took a little bit of a haircut. Tesla is still standing. I think Tesla today will actually announce shipments or deliveries. It's either today or tomorrow, but usually it's the first Sunday after the quarter. So we'll see what happens with Tesla.
Right. Yeah. Now I don't expect to hear a lot of good news about forecasts.
No.
In the earnings.
How could you? I mean, no, I mean, so I was as you know, I was an accountant coming out of school. I did general ledger. I did quarterly reporting. And let me just tell you by
the way, that's what Tom Bowley did too.
Awesome.
He did quarterly reporting for major companies.
Yeah. So this is what I would be doing in those meetings. They probably already started, but they will start Monday.
Yeah.
Folks, we have some stuff on our balance sheet that we need to clean up. This is going to be a quarter where everybody reports bad news. Time to make this the kitchen sink quarter.
Yep. Lower the bar.
Lower the bar. You're going to have pain. Make it acute. Make it one time. There are going to be, we'd be writing off goodwill. We'd be writing off all kinds of stuff. Just throw it in so all future quarters look better.
Lower the bar as far as we can to make sure we can exceed it next quarter.
Well, we can exceed it the next 5 quarters. It's going to be the kitchen sink quarter, in my opinion. So,
yeah,
buckle up.
By the way, Wall Street market knows that.
I don't know, dude. Their earnings forecasts are still really rosy. They got to be coming down.
They'll come down.
They have to. They have to.
But just because the earnings forecast is rosy doesn't mean that the market itself is going by that.
Oh, no, the market versus, the 12 or 20 analysts. No, totally get it. Absolutely right. Yeah. The market sees this coming.
Yeah. I think the market has a little more to go, but we're getting close.
Very cool. Well,
one thing I said in the newsletter is it's too late to short anything.
Interesting.
So don't start thinking, Armageddon's coming and it's the end of the world. So I'm going to start shorting. It's too late for that.
Yeah,
it's just like the people on Sanibel Island that decided to stay. Once the causeway was taken out, it was too late to leave. They had nothing to do. There was nothing they could do.
Yeah, I just wanted to put this in one of our videos. I think I'm going to put it here. Dan, I actually bought a stock on Friday.
Whoa!
That's big news for me.
It's a 20-year event.
Yeah, 20-year event. I bought 20 shares of JP Morgan because it hit, and I caught it at the low, 104.40, I think, or something.
Nice.
Like and I'm reinvesting dividends.
It might be a good one. We'll talk about it in the second one. We'll talk about some of the 52-week low companies. Let me. Am I sharing? I'm not sharing yet. All right. Let me share some. I might use my. This is my newsletter. I might use some of this. It said, as you probably know, the market has closed below the June lows and may likely be headed to 3,500. There are some glimmers of hope, which I'll talk about. All right, so first, let me go back, just as a reminder, let me go back to something we talked about long, long ago, and that's this secular bull market. So, at times like this, it always feels like we're never going back up again, right? But these are secular bull markets going back to 1930, so almost 100 years. And they typically last 18 to 20 years, and then they have a period of secular bear markets when it goes sideways. And I'm going to talk about what it would take for us to get back to a secular bear market. I'll show you that here in a second. One thing that I also said in my newsletter is, see if I can go to it real quick. I found an interesting quote right here. Quote of the day: when the time comes to buy, you won't want to.
Exactly. Yes.
Right. So I've been warning about September as the worst month. October is known for black swan events and fast selling, like the 1987 flash crash and the crash in 1929. It's also, by the way, known as the bear killer.
Yes, I've heard that recently, the bear killer. Yes.
Right. So October is a time when we could see a significant bounce. So this is kind of that same chart that I just showed you that goes back 100 years, but this one just goes back 20 years. Okay. And it goes back to the beginning of the secular bull market. The secular bear market that I showed you before officially ended in, you could say, 2013, when it broke out of this high right here, where I have that blue arrow. Or you could say 2009, when the rally first began after the 2008. You could pick either one of those. I mean, officially, you really should wait for it to break out above the high, because it could go right back down and you'd still be in that bear market, right? So 2013 is probably the official time. But in order for us to get back to a secular bear market, a couple of things will have to happen. So the momentum will have to change significantly. Up here is relative strength. And this is, by the way, this is a monthly chart. So these are very slow moving indicators. Every one of these bars right here is for 1 month.
Okay.
Okay. So you can see right here, even though the 2009 is when the rally began, the RSI, the relative strength, didn't get back out above 40 until around the end of 2009. It came out well before the 2013, actual breakout. But this 40 line is really important. So it never got back below it. All the times we went back and had a slight correction. We had one here in 2015. We had a correction here in 2018. Came all the way down. We had the COVID crash right here, which, by the way, did not break that secular bull market. Each one of these, the RSI never went below 40. Okay, so that's the first thing we got to watch. Will it get below 40? It's getting pretty close.
It's at 42.8. Looking at this.
That's right, 42.8 right now. Now remember, this is a monthly chart.
Right, that's true.
So it's going to take, this will take, for it to get below 40 will probably take 3 or 4 more months. Okay. For that to happen, unless we have a huge crash. If we have a black swan event, then everything's off. Right. The second one is the PPO, which is the price performance oscillator. And this is a percentage oscillator of the percentage amount that price is going up or down. So think of it as a momentum oscillator. Right now it's headed down, but again, in the secular bear market, right here, the lines, don't think about the graph below it, but the line itself, the black line in particular. Right here, it went below the 0 line, 0 point. So it was down below the 0 point through this whole secular bear market, except for a rally right there in the middle. Okay. Once we started into the secular bull market, it has never gone below it. All right, that's an indication that we're still in a secular bull market. Okay. Okay. And you can see this is the support line down here, which goes up to about 3,200. All right, so this one here needs to get below 0 too, for us to end the secular bull market. So keep that in mind. This is a chart that I showed. This is what I call my bottom finder. All right, first at the top, this is a PPO. This is now on a daily chart. All right, so this just goes back about a year. You can see the PPO up here, the momentum oscillator is still falling. So think of this as like you're in a car and you're wanting to come to a stop, but you either put your foot on the brake and you start to slow down with your foot on the brake, or your foot is still on the accelerator and you're still accelerating, right? Right now, it's still accelerating. It hasn't turned up yet. Right. You can look back way back here for the June bottom back here. This started to turn back up and it crossed back over. And then we had that nice rally. That hasn't happened yet. However, the RSI, even though we got the low, we got a lower low right here, lower than the June low. The relative strength indicator did not go to a lower low on it, at least not yet. I mean, it still could keep going down. But if this reverses and starts to go back up, now I think we still have probably a couple of weeks left. We might have a brief rally because everything is so oversold, but I'll talk about that in a minute. But that is still higher than the previous one. So even though the price is lower, the RSI is higher. That's a positive bullish divergence. And then down here, this red one is the percentage of stocks above their 50-day moving average. Typically what happens with this bottom finder is I want a put call ratio above 0.75. This is that pink line across here. I want a VIX above 30. And I want the percentage of stocks above their 50-day moving average to be below 10%. That's this line. When all three of those things happen, we're getting close to a bottom. The last time all three of those happened, we're right back here on the June low. You can see here the percentage below 50. This actually at one point got down to 0.6. This is the S&P 500. So 0.6 on the S&P 500 is 3 stocks. There are only 3 names above their 50-day. Right now it's at 3.2. So there are only 16 stocks above their 50-day. I'm going to show you what those are in our next session. Put call ratio back here, the June low, you can see how high it was right there. And it's even higher this time.
There's a lot of negativity.
Everyone is bearish.
Yeah.
Everybody is selling. But the funny thing is, it was actually higher a week ago than it was when we hit this new low. So there were more people were buying more puts a week ago than they were on Friday when we hit the new low. And then the VIX, same thing with the VIX. If we look back here at June, the VIX was above the pink line, just like the put call ratio and the number of stocks below 50. This was above 30, but again, it's starting to head down. So there are some indications that we may have a brief rally. It's going to be a reaction rally only because it's so oversold. Everyone, maybe we should have a Zuber indicator. As soon as Zuber buys his first stock in 20 years, we're about to have a rally.
Well, I just bought it. I bought it at the close, 104.40.
There you go. The rally's coming Monday.
JPM, baby. I bought it literally the last minute of closing.
This is I've shown this before. This right here is the ATR, the average true range. So the dark one in the center is one, the amount that it moves in one day. The second dark, little bit lighter one on the outside is 2 times the amount it moves in one day, and the lightest one is 3 times. That is very extreme. It very rarely gets that far. It did up here on the upside, and that was just before it started falling off. It did over here on the downside in June, the June low, and that's when it started to rally. Now we'll usually rally, and we did a whole session on reversion to the mean.
We did.
So your listeners should understand that now. But the reversion to the mean would send it up here to 38.50. And I've actually seen some forecasts from some other traders and technical analysts saying that if we have a rally, we probably are going back to 38.50. But I'll talk about October in a second. I think we still have some more downside, and we might get to 3,500 in October. All right. This is the long-term trend. This is sort of like what I showed before. This is from 2009 all the way up. The market is even in the corrections, it came back to the center line, except for the COVID crash, where it came all the way down. So this is basically the channel that we're following. to stay in that secular bull market.
So if
It
I read
just-
this correctly, we'd have to go below, call it 2950 or 2900.
Yeah, well, by the time we get there, and this is a weekly chart, so this will move a little bit slower too. But by the time we get there, we could call it 3,000.
Okay. Oh, I
All right.
got you. Okay. Yep.
This line across here is the high just before the COVID crash. So that's 3,400. That's a major support line right there.
Yeah.
So 3,500 is one. I'll show that in a second. We could easily blow through it. We're only 100 points away. Could easily blow through it and get to 3,400 and then bounce.
Okay.
This here is, these are the Fibonacci levels, as well as the blue ones are the Fibonacci levels. The pink ones are a quadrant. These are quadrants. Stock market often moves symmetrically. Okay. So the pink ones uses a quadrant based on the high. All right. So it just brings that, you put it on the high and you just move it down until, actually you just move it until it gets to the high, and it shows you the symmetrical area. So the first one was here at 4,300. Remember that one? 4,300 was a major support line right there.
Yep.
The middle one here is at 3,700. You see we hit it right along here. Remember, this is a weekly chart. So we hit it right along there. 1, 2, 3, 4, 5 weeks in a row. The next one down here is at just below 3,200.
Okay. So
that's the next major one there. And then the blue ones are the Fibonacci levels. So you can see a Fibonacci level at 3,815. We kind of traded around it here, then we blew through it right there. The next level is 3,500, which I've talked about before. And the next one below that is 3,200. Now the Fibonacci levels are calculated by taking the high, or taking whatever high and low you want. But what I did was I took the high that we hit in December, and I pulled it down here to the low after the COVID crash. So that's the measurement we're using. So that was 2192 basically was the low. So the next major level after 35 is 32. And you can see the quadrant is at about 3180. So 32 is a major support level.
Okay.
We could get there. So we'll see. And then this one here is just kind of a channel. Again, you can see how stretched we are right now. This is the COVID high, this line right here. It's at 30, just below 3,400. So again, we could blow through 3,500 and make it to 34. That's the COVID high just before COVID started. Right. That is also a really major one. So between 3,200 and 3,400, it's going to take a lot of work for it to make it through to 3,200. Right. If it does, I think it will be a very fast one. Okay. I think it could happen in a day or two. We could have a huge crash and then a complete reversal. Interesting. So that it'll be very violent if that happens. Okay. And then I think, yeah, the next one we'll save for the next video. But the last thing I want to show, this is from VectorVest. I put this in the newsletter, some things in the newsletter from VectorVest as well. This also, so this is the VectorVest index. So S&P 500 uses 500 stocks. Dow 30 uses 30 stocks. VectorVest uses 4,800 stocks. Oh, wow. Okay. So it's a much broader index. It gives you a much better, it's hard to make a reference point because most people don't think in terms of this. They mostly think of the S&P, but it's a much broader view. Okay. So again, even though we got to the low in the S&P on Friday, we did not get to a low on the 4,800 stocks that VectorVest follows. All right, so it's still accelerating here. It hasn't turned up yet. So we'll have to see what happens. So my conclusion at the end of my newsletter, oh yeah, this is the dollar. Oh yes. The dollar has just been screaming higher. Yep. I actually think that this dollar chart right here is something that is going to be concerning to the Fed. I think the Fed is hoping to see a little bit of easing up in inflation so that they could pause a little bit and let the dollar start coming down. If the dollar comes down, gold is going to scream higher. So if anybody wants a quick trade, watch the dollar. If it starts to plunge, which it will at some point, then gold is going to start screaming higher. So this is VectorVest, and I put this in the narrative from VectorVest that they put every week out there. The buy sell ratio is at 0.05. When it gets below 0.2, the market's looking for a bottom. 0.2, it's at 0.05. It's 75% below 0.2.
Yeah.
The MTI, which takes a combination of all these indicators and puts them all into one market timing indicator, when it's below 0.6, the market's looking for a bottom. It's at 0.38 right now. So this is the narrative talking about, explains all of those things in this narrative. And it also says that prudent investors should not buy stocks at this time, but should be getting their bargain hunting and bottom fishing lists ready. Aggressive investors should play the market with a bias to the downside, being alert for an explosive rally. And I've been hearing that in all of the newsletters that I get. I've been hearing that consistently. Everyone's saying we are due for an explosive rally. And then this is from Stock Traders Almanac. They talk about the bear killer, October being the bear killer. And there's a lot of data in here. Stock Traders Almanac really uses historical data going back, 70 years or more. But one of the things that they put in there, they said this is historically during a midterm election of a new Democratic president. All right, so this is the history, the black line here. This is the history of a midterm year for a new Democratic president. And you can see here, we've been kind of a little more extreme than the historical view. But you can see here in September, it continued down as we did. We came down actually even more. But it has a brief rally right here in October.
Yep.
And then it hits a new low. So that's where our 3,500 or 3,200 could come into play.
Okay.
The last week of October. From that point on, it starts heading higher for the rest of the year. All right. Let me just give my newsletter on here.
Folks, again, if you want to get this, again, it's free. He puts it out every week. I get it, look at it, as do nearly 1,000 other One Rental at a Time fans. It is at breakpointtrading@gmail.com. He will do you a favor and send you last week's as he adds you to the list for next week. Dan, thank you.
Yeah, and I probably won't send last week's because I had trouble sending it.
Oh, that's right.
But I will send this week. I'll send this particular one if anybody wants to sign up. And this one has the Hurricane Ian photos in there and where my house is and all that kind of stuff.
I think the article on the bear killer is worthwhile just by itself. So
yeah,
send him an email, breakpointtrading@gmail.com. Thanks, buddy.
Great. You bet.